Today we're going to clear up a question a lot of people have, especially if you're just starting to manage your money. What's the difference between a credit card and a debit card? At first glance, they look the same. Both are plastic, have a chip, and let you pay in stores and online. But in reality, they work very differently. And understanding the difference can help you make smarter financial decisions. Let's break it down step by step. Let's start with the debit card. A debit card is directly connected to your bank account, whether it's checking or savings. That means when you use it to pay or withdraw cash, the amount comes out immediately from your available balance. For example, if you have $500 in your Bank of America account and you make a $100 purchase with your debit card, the bank will deduct that $100 instantly, leaving you with $400. Here's what's important to remember. You're not borrowing money. There are no interest charges. You're not going into debt. You can also use your debit card to withdraw cash from ATMs. If you use your own bank's ATM, you usually won't be charged any fees. But what happens if you don't have enough money in your account? If you try to spend or withdraw more than you have, your transaction will be declined. Unless you've enabled overdraft protection, in that case, the bank might let the purchase go through, but they'll charge you extra fees. Now let's look at the credit card. When you buy something with a credit card, the bank is lending you the money, but they won't charge you interest right away. You get what's called a grace period to pay it back without any extra fees. Here's an example. Let's say your billing cycle ends on the 10th of each month. That means all purchases from June 11th to July 10th will be on the same statement. Now imagine you buy a TV for $600 on June 15th. That purchase will appear on the statement that closes on July 10th. Your payment due date might be July 30th, about 20 days after the cycle ends. So from June 15th to July 30th, you have almost 45 days to pay the $600 with no interest. If you pay by July 30th, you won't pay a penny in interest. But if you miss that date, the bank can charge interest from either the day you made the purchase or the due date, depends on the bank. To get a credit card, banks usually want to see two things. Stable income, like a regular paycheck, so they know you can repay what you borrow. A good credit history, kind of like a report card that shows how well you've handled past loans or bills. If you meet those requirements, it's easier to get approved. Let's say Laura and David are walking through the mall and realize they need cash to pay for parking. Laura uses her Chase debit card. She goes to her bank's ATM and withdraws $60. Since it's her bank's ATM, there's no fee. The money comes straight out of her checking account. Easy, no problems. David, on the other hand, doesn't have enough in his bank account, so he uses his Capital One credit card to withdraw cash. That's where things get expensive. He gets charged a cash advance fee, usually between $5 and $10 just for the withdrawal. Plus, interest starts piling up right away, often 25% or more, with no grace period. If he withdraws $100, he could easily end up paying $120 or more if he doesn't repay quickly. So if you need cash, use your debit card. Only use your credit card at an ATM as a last resort. Which one is safer? When it comes to security, credit cards have the edge, especially in the US. Why? Fraud protection. If someone makes an unauthorized purchase with your credit card, you can report it to the bank. They'll freeze the charge while they investigate, and you don't have to pay anything in the meantime. Credit cards also come with extra benefits like purchase protection. If something you buy is damaged or never arrives, the card might refund you or replace it. Car rental insurance. Many cards cover damages or theft when you rent a car using the card. Trip cancellation coverage. If you cancel a trip for a valid reason, the card may reimburse your flights, hotels, or tours. Debit cards do offer some fraud protection too, But there's a big difference. If someone steals your debit card info and uses it, the money is taken directly from your account. Even if the bank refunds it, the process can take longer, and during that time, you won't have access to those funds. Credit cards protect you better because they act as a buffer between your bank account and the outside world. Where are they accepted more? Most stores now accept both types. But there are some situations where credit cards are preferred, like renting a car, booking a hotel, or subscribing to services like Adobe or Netflix. Why? Because credit cards guarantee payment, even if your checking account is empty. Today many services also accept debit cards, PayPal, or Apple Pay, so credit cards aren't as essential as they used to be. In summary, debit card, you're using your own money from your bank account. Credit card, you're borrowing money from the bank and paying it back later. Which one is better for you? It depends on your habits. If you manage your money well and pay off your balance in full every month, a credit card can be a powerful tool. It offers rewards, security, and helps build your credit score. But if you tend to overspend or lose track of your budget, a debit card is safer. It keeps you out of debt. What about you? Do you prefer using credit or debit? Which one has worked best for you? Let me know in the comments below. If you like this video, give it a thumbs up, subscribe to the channel, and turn on notifications so you don't miss our next personal finance tips. See you next time.